57,000. Just 57,000 jobs were added to the U.S. economy. That is the provocative number all of us are digesting today, and it set off a massive global market chain reaction, unraveling momentum trades across currencies and tech stocks in a matter of minutes.
Hello everyone, welcome back to AI Market News. Today, we're exploring how a single macroeconomic data point completely reshaped our portfolios. We're going to trace the shockwaves from Wall Street all the way to the trading floors right here in Tokyo, unpacking the mechanics behind the massive capital rotations we just witnessed. Section 1. The Jobs Data Shock. Based on available data, the June U.S. jobs report fell drastically short of expectations. The market had established a consensus forecast of 113,000 jobs, but the actual print was a mere 57,000. To truly understand this shift, all of us must look at the core metric involved, non-farm payrolls. This is a key economic indicator measuring the number of jobs added or lost in the U.S. economy, excluding farm workers. Why does this specific metric trigger such market chaos? Well, it's the primary gauge for central bank policy. A dramatically lower job count signals a cooling economy, which immediately pressures the central bank to reconsider keeping interest rates high to avoid accidentally tipping the economy into a recession. Now, the contrast here is really fascinating. Payrolls plunged, yet the unemployment rate actually improved from 4.3% to 4.2%. So how does that happen? The underlying mechanic here is that the labor market is cooling down, but it isn't collapsing. The participation rate dropped, meaning fewer people were actively looking for work, which technically improves the unemployment percentage. Because it wasn't a total collapse, the Federal Reserve still has some cover, but expectations for a rate hike have now decisively shifted from September to October. Section 2. USDJPY battle at 160. The immediate ripple effect of that U.S. data hit the currency market like a tidal wave, dropping the dollar-yen pair from 162 down to 160.63 in just minutes. We call this sudden market reaction a hawkish unwind. This is the rapid selling of assets that previously benefited from expectations of higher interest rates. Why did this happen so aggressively? It all comes down to yield advantage. As expectations for high U.S. interest rates suddenly faded with the weak jobs data, the lucrative yield advantage of the dollar over the yen immediately shrank, causing traders to rush for the exits and triggering a massive sell-off. So, the key takeaway is that 160 is the new battleground for the dollar-yen. According to current market information, the pair found support right at this level overnight, but all of us need to watch this closely. A decisive close below the 160 support level on a weekly basis could signal a genuine reversal of this 39-year high momentum trade. Section 3. Wall Street Sector Rotation. The macroeconomic data didn't just rattle currencies, it fueled a massive shift in U.S. equities through a classic sector rotation. This is the movement of investment capital from one industry sector to another in anticipation of shifting economic cycles. The why behind this mechanic is simple risk management. As the economic outlook cooled, investors decided to lock in their massive profits from high-flying tech stocks, dynamically moving that capital into traditional, stable, dividend-paying companies like consumer goods and healthcare to protect their portfolios. And as all of us can see in the chart, this rotation had a historic impact on the Dow's performance. By the 4 p.m. ET close, the Dow Jones surged an incredible 594 points to achieve a record finish above 52,900. This wasn't a rising tide lifting all boats. This was a highly targeted, concentrated surge driven entirely by this sudden sector rotation. When we break down the specific companies, the rotation becomes crystal clear. The winners were the blue-chip mainstays. Companies like Boeing and McDonald's saw significant capital inflows. Conversely, the losers were the recent market darlings. The buy semiconductors no matter what thesis lost its footing, meaning heavyweights like Nvidia and Tesla faced immediate and heavy selling pressure. But perhaps the most telling visual is this one. The graph shows the S&P 500 closed essentially flat. This perfectly illustrates the internal dynamics of the session. It was a zero-sum capital shift. The billions of dollars flowing out of the Nasdaq directly funded the surge in the Dow, leaving the broader index perfectly balanced in the middle, effectively masking the fierce rotation happening beneath the surface. Section 4. Nikkei's extreme volatility. Now let's bring the narrative home to our domestic market. As we can see in the chart, the Nikkei opened sharply lower, tracking Wall Street's tech sell-off to drop over 1,100 points. However, the index then fiercely reversed that massive decline to close up 1,010 points by the end of the JST trading session, finishing at 69,744.
An intraday swing of over 2,000 points in a single session underscores just how extraordinarily volatile this global trade has become.
So, why did the Japanese market bounce back with such force? It came down to technical boundaries. The 50-day moving average held as a firm line of technical support. The underlying mechanism here is that while early panic sellers dumped shares, algorithmic and technical buyers aggressively stepped in right at that moving average line. They utilized the dip to scoop up shares of key domestic players like Kioxia, completely reversing the market's trajectory.
Section 5. Calendar and looking ahead. So where do we go from here? Well, 1 month of weak data doesn't definitively break a trend, but it certainly complicates the picture. Here's what all of us should be watching as we manage our portfolios. First, the broader AI and semiconductor trade desperately needs a new catalyst. With macro momentum fading and positions looking a bit crowded, the next major driver will be Q2 earnings. The fundamental structural case for AI remains, but the market now requires hard, forward guidance from foundries like TSMC and memory leaders like Samsung over the next 2 weeks to justify current valuations. Finally, looking at our immediate economic calendar, there are a few critical dates all of us must prepare for. On July 7th JST, Tokyo reopens after the US holiday weekend, which will truly test market liquidity. Then, crucially, at 8:30 a.m. ET on July 10th, we receive the US June CPI data. If that inflation print comes in hot despite softening employment, central banks will face an incredibly uncomfortable policy dilemma.
The ultimate question now is, will the Fed cut rates in time to secure a soft landing? Or is this rotation just the beginning of a broader market retreat? Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.